Hi everyone, I'm Martin Bamford. How worried should investors be about the Omicron variant of the coronavirus? Markets experienced a pretty shitty day on Friday, with the FTSE 100 index of leading UK company shares having its worst fall in almost 18 months. Stock markets around the globe took a tumble because investors are scared that this new COVID variant will trigger another round of lockdowns, derailing economic recovery. I want to take a look in this video at what happened when investors reacted to this news of the Omicron variant, and what's likely to happen next. There's a few scenarios I think could play out over the next few months. Starting here in the UK then, with the FTSE 100 index down 3.6% on Friday, its worst session since June 2020, back in those fairly early days of the global pandemic. As newspaper headline writers love to tell us, £72 billion wiped off the value of the UK stock market on Friday. It was a slightly worse picture on the continent, with the German DAX index down 4.2% and the French CAC index down 4.8%. The S&P 500 in the US was down 2.3%, its worst day since February this year. We also saw a fall in the price of oil, with the benchmark Brent crude down by 10%. That's its biggest fall since April 2020. Now, oil, other commodities, they're a pretty good indicator of economic sentiment, because when traders anticipate lower demand for oil, thanks to restriction on international travel, for example, the price falls. The key question right now seems to be, does this new variant have sufficient mutations to escape and evade existing vaccinations? It's really important to say at this stage that we don't yet know enough about Omicron, and a lot more data will no doubt come out in the coming weeks and months, revealing the true picture of this variant and also what it's likely to mean for the global economy. What we do know right now is that Omicron was first detected earlier this week in South Africa, and it's subsequently been identified in Belgium, and as of earlier today, a couple of times here in the UK, once in Essex and once in Nottingham. Scientists are concerned that the variant is more transmissible than previous variants, even Delta, which seems to be far more transmissible than the original. But this question of whether it's likely to render existing vaccines ineffective, that becomes the million-dollar question. One way we can attempt to measure investor sentiment is by looking at VIX, the so-called fear index, which has risen by 57% in the past 5 days. VIX is a measure of market volatility, and we call it the fear index because market volatility tends to increase when investors are more fearful. We can also look at bond yields, because during times of investor nervousness, risk assets, risk money, such as money invested in equities, tends to find its way into government bonds and also into low yield or safer corporate debt. Yields on 10-year US Treasuries, which is a benchmark for this sort of thing, fell by 0.1 percentage points to 1.53%, and UK 10-year gilt yields fell by 0.15 percentage points to 0.828%. Now, that suggests a bit of a flight to safety, but nothing too extreme. Another consequence of this emerging variant is market expectation of an interest rate hike next month has now stepped back a little, from almost certainty to a now 70% chance that the Bank of England will put up interest rates. Now, that's still pretty likely, according to markets, but investors do seem to be hedging their bets a little bit more now. I think investment markets have probably overreacted a little bit to this variant news. They might overreact a bit more in the short term, that's what they do, until more data becomes available and there's a little bit more certainty about what all this means for the global economy, for the global economic recovery. The World Health Organization says that this variant has a large number of mutations, some of which are concerning. They're looking at the early evidence which suggests an increased risk of reinfection, and they've labelled it as a variant of concern, or a VOC, asking countries to enhance surveillance and sequencing efforts so they can better understand circulating variants. Where countries have capacity to do so, the WHO wants them to perform field investigations and laboratory assessments to improve understanding of the potential impacts of this VOC on epidemiology, severity, effectiveness of public health and social measures, diagnostic methods, immune responses, antibody neutralization, and other relevant characteristics. So it's early days, probably too early to start catastrophizing. That said, I think the UK government response today is entirely sensible, returning the mask mandate as a temporary and precautionary measure. Close contacts of those with the Omicron variant will have to self-isolate, regardless of their vaccination status, so back to how it used to be, and there will be mandatory PCR tests returning for those entering the UK from overseas. And why not on all of this? These measures have got limited impact on our social freedoms, but they could help reduce the spread of this virus variant. And if further investigation showed that this variant is more transmissible, more deadly, and that existing vaccinations are less effective, then doing simple stuff now, stuff within our control, rather than waiting weeks or months to do that. That makes a great deal of sense. A lot of things are different this time round. Officials at Moderna Therapeutics and the US government have previously said that COVID vaccines, reprogrammed to aim at emerging new strains of the virus, the variants, could reach the market quickly without going through large-scale clinical trials. Much would depend, of course, on the view of regulators, but scientists developing these vaccines could tweak them to make them more effective against variants as they emerge. In fact, minutes before I recorded this video, Pfizer said it will be able to manufacture and distribute an updated version of its COVID-19 vaccine within 100 days if the new variant Omicron is found to be resistant to the current vaccine, and that's the big if. This time round we have antivirals. It was only 3 weeks ago that the Medicines and Healthcare Products Regulatory Agency, the MHRA, announced the antiviral Lagevrio is safe and effective at reducing the risk of hospitalisation and death in people with mild to moderate COVID-19 who are at increased risk of developing severe disease. However, and this is less positive, we've heard in the last day or so that the efficacy of the Merck COVID antiviral is less than first thought. It's falling to around 30% in the latest stage tests. From a financial perspective, something that should perhaps concern investors at least a little bit is the current level of market valuations. When COVID first hit the world, the short-term market correction we saw was fairly sharp, in part due to the froth carried by global equity markets at the time. The bigger they are, of course, the harder they fall. But stock market valuations today are more stretched than they were at the start of the pandemic. The Buffett indicator, for example, the ratio of total United States stock market valuation to GDP, it stood at 216% on the 24th of November. A fair value, by the way, is around 120%. It's called the Buffett indicator because legendary investor Warren Buffett once said to Fortune magazine that comparing equity valuations to GDP is, and I quote, probably the best single measure of where valuations stand at any given moment. Investors thought they had put COVID behind them. We all knew it wasn't a done deal. I think we knew that in our heart of hearts, but the winter months in the Northern Hemisphere were bound to bring us a resurgence in the virus thanks to more indoor mixing and probably some snogging at the Christmas parties under the mistletoe. But that assumption has been turned on its head by Omicron. Bank of America, in its very recently published survey of investment fund managers, placed COVID risks at number 5 on their list of tail risks after price inflation, central bank interest rate hikes, stalling economic growth in China, and asset bubbles. You've got to reckon they're rethinking that assessment right now. A reason I'm quite optimistic about this one is that the investment shock from the early days of the COVID pandemic is still in recent memory. Now, I'm often critical of investors for having short memories, along with this constant belief that somehow this time it will be different. But we are so painfully close still to March 2020, April 2020. We know how this one is likely to turn out from an economic and investment perspective, so an overreaction is less likely. And this time round, we've got existing vaccines. The worst case scenario will remain partly effective, and best case could be updated within a matter of months, so very quickly. We've got governments who should be better prepared this time round, having seen what works and what doesn't work, both here at home in the UK, but also overseas. The timing of this sucks for some sectors, especially retail and hospitality, who are banking on the next couple of months for a significant boost to their earnings. Even with the new face mask mandate, I suspect some people will be less willing now to hit the high street or indeed go snogging their colleagues under the Christmas party and mistletoe. What do you make of all of this? Will Omicron be an economy and markets killer, or will investors shrug it off? Do let me know in the comments. I'd love to hear from you. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.